Lesson 2. Why Teach Financial Literacy? In 1990, my best friend Mike took over his father's empire and is in fact doing a better job than his dad did. We see each other once or twice a year on the golf course. He and his wife are wealthier than you could imagine. Rich Dad's empire is in great hands, and Mike is now grooming his son to take his place, as his dad groomed us. In 1994, I retired at the age of 47, and my wife Kim was 37. Retirement does not mean not working. To my wife and me, it means that, barring unforeseen cataclysmic changes, we can work or not work, and our wealth grows automatically, staying way ahead of inflation. I guess it means freedom. The assets are large enough to grow by themselves. It's like planting a tree. You water it for years, and then one day it doesn't need you anymore. Its roots have gone down deep enough. Then the tree provides shade for your enjoyment. Mike chose to run the empire, and I chose to retire. Whenever I speak to groups of people, they often ask what I would recommend, or what could they do? How do they get started? Is there a good book I'd recommend? What is the secret to success? I simply say to them what my rich dad said back to me when I was a little kid. If you want to be rich, you need to be financially literate. That idea was drummed into my head every time we were together. As I said, my educated dad stressed the importance of reading books, while my rich dad stressed the need to master financial literacy. If you're going to build the Empire State Building, the first thing you need to do is dig a deep hole and pour a strong foundation. If you're going to build a home in the suburbs, all you need to do is pour a 6-inch slab of concrete. Most people, in their drive to get rich, are trying to build an Empire State Building on a 6-inch slab. Our school system, having been created in the agrarian age, believes in homes with no foundation dirt floors are still the rage. So kids graduate from school with virtually no financial foundation. One day, sleepless and deep in debt in suburbia, living the American dream, they decide that the answer to their financial problems is to find a way to get rich quick. Construction on the skyscraper begins. It goes up quickly, and soon, instead of the Empire State Building, we have the Leaning Tower of suburbia. The sleepless nights return. As for Mike and me in our adult years, both of our choices were possible, because we were taught to pour a strong financial foundation when we were just kids. Now, accounting is possibly the most boring subject in the world. It also could be the most confusing. But if you want to be rich, long term, it could be the most important subject. The question is, how do you take a boring and confusing subject and teach it to kids? The answer is, make it simple. My rich dad poured a strong financial foundation for Mike and me. Since we were just kids, he created a simple way to teach us. For years, he only drew pictures and used words. Mike and I understood the simple drawings, the jargon, the movement of money. And then in later years, Rich Dad began adding numbers. Most importantly, you must know the difference between an asset and a liability, and buy assets. If you want to be rich, this is all you need to know. It is rule number 1. It is the only rule. This may sound absurdly simple, but most people have no idea how profound this rule is. Most people struggle financially because they do not know the difference between an asset and a liability. Rich people acquire assets. The poor and middle class acquire liabilities, but they think they are assets. When Rich Dad explained this to Mike and me, we thought he was kidding. Here we were nearly teenagers and waiting for the secret to get rich, and this was his answer. It was so simple that we had to stop for a long time to think about it. If it's that simple, how come everyone's not rich? I asked. Rich Dad smiled, because people do not know the difference between an asset and a liability. I remember asking, how could adults be so silly? If it's that simple, if it's that important, why would everyone not want to find out? It took our Rich Dad only a few minutes to explain what assets and liabilities were. To teach preteen boys, Rich Dad kept everything simple, using as many pictures as possible, as few words as possible, and no numbers for years. My Rich Dad simply drew a vertical box with a line through the middle. The top half was for income, and the bottom half was for expenses. Then beneath that box, he drew another box horizontally, which he divided into a left half for assets and a right half for liabilities. The income statement, often called a profit and loss statement, measures income and expenses, money in or money out. The second set of boxes is the balance sheet. It's called that because it's supposed to balance assets against liabilities. That relationship is vital to understand. The primary cause of financial struggle is simply not knowing the difference between an asset and a liability. The cause of the confusion is found in the definition of the two words. If you want a lesson in confusion, simply look up the words asset and liability in the dictionary. So my rich dad simply told two young boys the following. An asset is something that puts money in my pocket. A liability is something that takes money out of my pocket. This is really all you need to know. If you want to be rich, simply spend your life buying assets. If you want to be poor or middle class, spend your life buying liabilities. It's not knowing the difference that causes most of the financial struggle in the real world. My rich dad then drew 3 arrows on his diagram. He explained, the arrow represents the flow of cash, or cash flow. In 80% of most families, the financial story is a story of working hard in an effort to get ahead. It's not because they don't make money, but because they spend their lives buying liabilities instead of assets. The first arrow showed the cash flow pattern of a poor person or a young person still at home. The arrow goes into the income box from a job or salary. It then continues into the expense box. Expenses include taxes, rent, and everyday living expenses. It flows out the expense box and is gone. The second arrow Rich Dad drew represented the cash flow pattern of a middle-class person. The arrow flows from a job into the income box. It then flows into the liabilities box. Most middle-class people acquire many liabilities, such as a mortgage, a car loan, and credit card debt. From the liabilities box, it flows to the expense box, where the monthly payments are made for the liabilities, as well as taxes and living expenses. From there, it flows out the expense box and is gone. The third arrow is the pattern of a wealthy person. This arrow simply flows from the asset box into the income box. The cash flow is not generated by a job or salary, but by assets. Remember, assets are things that put money in your pocket. Additionally, the rich have few expenses and liabilities, or if they do, those liabilities are more than covered by their assets. Examples such as these are oversimplified. Everyone has living expenses, the need for food, shelter, and clothing. The diagrams Rich Dad drew show the flow of cash through a poor, middle class, or wealthy person's life. It's the cash flow that tells the story. It's the story of how a person handles their money, what they do after they get the money in their hand. I cringe whenever I hear people ask me how to get rich quicker. Or how do they start? I often hear, I'm in debt, so I need to make more money. But more money will often not solve the problem. In fact, it may actually accelerate the problem. Money often makes obvious our tragic human flaws. Money often puts a spotlight on what we do not know. That's why, all too often, a person who comes into a sudden windfall of cash, let's say an inheritance, a pay raise, or lottery winnings, soon returns to the same financial mess, if not worse than the mess they were in before they received the money. Money only accentuates the cash flow pattern running in your head. If your pattern is to spend everything you get, most likely an increase in cash will just result in an increase in spending. Thus the saying, a fool and his money is one big party. Because students leave school without financial skills, millions of educated people pursue their profession successfully, but later find themselves struggling financially. They work harder but don't get ahead. What's missing from their education is not how to make money, but how to spend money. What to do after you make it. It's called financial aptitude. What to do with the money once you make it, how to keep people from taking it from you, how long you keep it, and how hard that money works for you. Most people cannot tell why they struggle financially because they don't understand cash flow. A person can be highly educated, professionally successful, and financially illiterate. These people often work harder than they need to because they learned how to work hard, but not how to have their money work for them. The moving picture show of hard-working people has a set pattern. Recently married, the happy, highly educated young couple move in together in one of their cramped rented apartments. Immediately they realize that they're saving money because two can live as cheaply as one. The problem is, the apartment is cramped. They decide to save money to buy their dream home so they can have kids. They now have two incomes, and they begin to focus on their careers. Their incomes begin to increase. As their incomes go up, their expenses go up as well, so there is little or no money to flow into the asset box. This means the only income they get comes from their jobs. The number one expense for most people is taxes. Many people think it's income tax, but for most Americans, their highest tax is Social Security. As an employee, it appears as if the Social Security tax, combined with the Medicare tax rate, is roughly 7.5%. But it's really 15%, since the employer must match the Social Security amount. In essence, it is money the employer cannot pay you. On top of that, you still have to pay income tax on the amount deducted from your wages for Social Security tax. Income you never receive because it went directly to Social Security through withholding. Then their liabilities go up. This is best demonstrated by going back to the young couple. As a result of their incomes going up, they decide to go out and buy the house of their dreams. Once in their house, they have a new tax, called property tax. Then they buy a new car, new furniture, and new appliances to match their new house. All of a sudden, they wake up, and their liabilities column is full of mortgage debt and credit card debt. They're now trapped in the rat race. A child comes along. They work harder. The process repeats itself. More money and higher taxes, also called bracket creep. A credit card comes in the mail. They use it. It maxes out. A loan company calls and says their greatest asset, their home, has appreciated in value. The company offers a bill consolidation loan because their credit is so good and tells them the intelligent thing to do is clear off the high-interest consumer debt by paying off their credit card. And besides, interest on their home is a tax deduction. They go for it and pay off those high-interest credit cards. They breathe a sigh of relief. Their credit cards are paid off. They've now folded their consumer debt into their home mortgage. Their payments go down because they extend their debt over 30 years. It is the smart thing to do. Their neighbor calls to invite them to go shopping. The Memorial Day sale is on. A chance to save some money. They say to themselves, I won't buy anything, I'll just go look. But just in case they find something, they tuck that clean credit card inside their wallet. I run into this young couple all the time. Their names change, but their financial dilemma is the same. They come to one of my talks to hear what I have to say. They ask me, can you tell us how to make more money? Their spending habits have caused them to seek more income. They don't even know that the trouble is really how they choose to spend the money they do have. And that is the real cause of their financial struggle. It's caused by financial illiteracy and not understanding the difference between an asset and a liability. More money seldom solves someone's money problems. Intelligence solves problems. There's a saying a friend of mine says over and over to people in debt. If you find yourself in a hole, stop digging. The poor and middle class all too often allow the power of money to control them. By simply getting up and working harder, failing to ask themselves if what they do makes sense, they shoot themselves in the foot as they leave for work every morning. By not fully understanding money, the vast majority of people allow the awesome power of money to control them. The power of money is used against them. By the time Mike and I were 16 years old, we began to have problems in school. We were not bad kids. We just began to separate from the crowd. We worked for Mike's dad after school and on the weekends. Mike and I often spent hours after work just sitting at a table with his dad while he held meetings with his bankers, attorneys, accountants, brokers, investors, managers, and employees. We learned more sitting at his meetings than we did in all our years of school, college included. Mike's dad was not school educated, but he was financially educated and successful as a result. He used to tell us over and over again, an intelligent person hires people who are more intelligent than they are. So Mike and I had the benefit of spending hours listening to, and in the process learning from, intelligent people. But because of this, both Mike and I just could not go along with the standard dogma that our teachers preached. Occasionally, Mike or I would ask our teachers how what we studied was applicable, or we asked why we never studied money and how it worked. To the latter question, we often got the answer that money was not important, that if we excelled in our education, the money would follow. The more we knew about the power of money, the more distant we grew from the teachers and our classmates. My highly educated dad never pressured me about my grades. I often wondered why, but we did begin to argue about money. By the time I was 16, I probably had a far better foundation with money than both my mom and dad. I could keep books. I listened to tax accountants, corporate attorneys, bankers, real estate brokers, investors, and so forth. My dad talked to teachers. One day, my dad was telling me why our home was his greatest investment. A not too pleasant argument took place when I showed him why I thought a house was not a good investment. The argument illustrated the difference in perception between my rich dad and my poor dad when it came to their homes. Poor dad thought his house was an asset and listed it in the asset box, and the rich dad thought it was a liability and put his home in the liability box. I remember when I drew a diagram for my dad showing him the direction of cash flow. I also showed him the ancillary expenses that went along with owning the home. A bigger home meant bigger expenses, and the cash flow kept going out through the expense column. Today I am still challenged on the idea of a house not being an asset. And I know that for many people, it's their dream as well as their largest investment. And owning your own home is better than nothing. I simply offer an alternate way of looking at this popular dogma. My wife and I would love a bigger, more flashy house to impress the Joneses, but we know it is not an asset. It's a liability since it takes money out of our pocket. So here's the argument I put forth. I really do not expect most people to agree with it because a nice home is an emotional thing. And when it comes to money, high emotions tend to lower financial intelligence. When it comes to houses, I point out that most people work all their lives paying for a home they never own. In other words, most people buy a new house every so many years, each time incurring a new 30-year loan to pay off the previous one. Even though people receive a tax deduction for interest on mortgage payments, they pay for all their other expenses with after-tax dollars, even after they pay off their mortgage. Then there are property taxes. My wife's parents were shocked when the property taxes on their home went to $1,000 a month. This was after they'd retired, so the increase put a strain on their retirement budget, and they felt forced to move. Also, houses do not always go up in value. I still had friends who owe $1 million for a home that will today sell for only $700,000. Finally, the greatest losses of all are those from missed opportunities. If all your money is tied up in your house, you may be forced to work harder because your money continues blowing out of the expense column. instead of adding to the asset column. The classic middle-class cash flow pattern. If a young couple would put more money into their asset column early on, their later years would get easier, especially as they prepared to send their children to college. Their assets would have grown and would be available to help cover expenses. All too often, a house only serves as a vehicle for incurring a home equity loan to pay for mounting expenses. In summary, the end result in making a decision to own a house that is too expensive in lieu of starting an investment portfolio early on impacts an individual in at least the following 3 ways. Number 1, loss of time, during which other assets could have grown in value. Number 2, loss of additional capital, which could have been invested instead of paying for high-maintenance expenses related directly to the home. Number 3, loss of education. Too often people count their house, savings, and retirement plan as all they have in their asset column. Because they have no money to invest, they simply do not invest. This costs them investment experience. Most never become what the investment world calls a sophisticated investor. And the best investments are usually first sold to sophisticated investors, who then turn around and sell them to the people playing it safe. My educated dad's personal financial statement best demonstrates the life of someone in the rat race. His expenses seem to always keep up with his income, never allowing him to invest in assets. As a result, his liabilities, such as his mortgage and credit card debts, are larger than his assets. My rich dad's personal financial statement, on the other hand, reflects the results of a life dedicated to investing and minimizing liabilities. His assets greatly exceed his liabilities. A review of my rich dad's financial statement is why the rich get richer. The asset column generates more than enough income to cover expenses, with the balance reinvested into the asset column. The asset column continues to grow, and therefore the income it produces grows with it. The result being, the rich get richer. The middle class finds itself in a constant state of financial struggle. Their primary income is through wages, and as their wages increase, so do their taxes. Their expenses tend to increase in equal increments as their wages increase, hence the phrase, the rat race. They treat their home as their primary asset instead of investing in income-producing assets. Remember, the most important rule is to know the difference between an asset and a liability. Once you understand the difference, concentrate your efforts on only buying income-generating assets. That's the best way to get started on a path to becoming rich. Keep doing that, and your asset column will grow. Focus on keeping liabilities and expenses down. This will make more money available to continue pouring into the asset column. This pattern of treating your home as an investment, and the philosophy that a pay raise means you can buy a larger home or spend more, is the foundation of today's debt-ridden society. This process of increased spending throws families into greater debt and into more financial uncertainty, even though they may be advancing in their jobs and receiving pay raises on a regular basis. This is high-risk living caused by weak financial education. As an employee who's also a homeowner, your working efforts are generally as follows. You work for someone else. Most people, working for a paycheck, are making the owner or the shareholders richer. Your efforts and success will help provide for the owner's success and retirement. Next, you work for the government. The government takes its share from your paycheck before you even see it. By working harder, you simply increase the amount of taxes taken by the government. Most people work from January to May just for the government. And finally, you work for the bank. After taxes, your next largest expense is usually your mortgage and credit card debt. The problem with simply working harder is that each of these 3 levels takes a greater share of your increased efforts. You need to learn how to have your increased efforts benefit you and your family directly. Once you've decided to concentrate on minding your own business, how do you set your goals? For most people, they must keep their profession and rely on their wages to fund their acquisition of assets. As their assets grow, how do they measure the extent of their success? When does someone realize that they are rich, that they have wealth? As well as having my own definitions for assets and liabilities, I also have my own definition for wealth. Actually, I borrowed it from a man named Buckminster Fuller. Some people call him a quack, and others call him a living genius. Years ago, he got all the architects buzzing because he applied for a patent in 1961 for something called a geodesic dome. But in the application, Fuller also said something about wealth. It was pretty confusing at first, but after reading it for a while, it began to make some sense. Wealth is a person's ability to survive so many number of days forward. Or, if I stopped working today, how long could I survive? Unlike net worth, the difference between your assets and liabilities, which is often filled with a person's expensive junk and opinions of what things are worth, this definition creates the possibility for developing a truly accurate measurement. I could now measure and really know where I was in terms of my goal to become financially independent. Although net worth often includes these non-cash producing assets like stuff you bought that now sits in your garage, wealth measures how much money your money is making, and therefore your financial survivability. Wealth is the measure of the cash flow from the asset column compared with the expense column. Let's use an example. Let's say I have a cash flow from my asset column of $1,000 a month, and I have monthly expenses of $2,000. What's my wealth? Let's go back to Buckminster Fuller's definition. Using his definition, how many days forward can I survive? And let's assume a 30-day month. By that definition, I have enough cash flow for half a month. When I have achieved $2,000 a month cash flow from my assets, then I will be wealthy. I now have income generated from assets each month that fully covers my monthly expenses. If I want to increase my expenses, I first must increase my cash flow from assets to maintain this level of wealth. Take notice that it's at this point that I am no longer dependent on my wages. I have focused on and been successful in building an asset column that's made me financially independent. If I quit my job today, I would be able to cover my monthly expenses with the cash flow from my assets. My next goal would be to have the excess cash flow from my assets reinvested into the asset column. The more money that goes into my asset column, the more my asset column grows. The more my assets grow, the more my cash flow grows. And as long as I keep my expenses less than the cash flow from these assets, I will grow richer, with more and more income from sources other than my physical labor. As this reinvestment continues, I am well on my way to being rich. The actual definition of rich is in the eye of the beholder. You can never be too rich. Just remember this simple observation. The rich buy assets, the poor only have expenses. The middle class buys liabilities they think are assets. So how do I start minding my own business? What's the answer? Listen to the founder of McDonald's.